Please read this disclaimer carefully before proceeding further. Welcome traders to this week's analysis of gold. My name is Vic. So what can we expect from gold in last few days of 2020? Now if you have been following my analysis for quite a while on gold, then you are aware that I am actually bullish on gold, but there is a technical reason why gold can still fall down. And the technical reason behind this is because of this W pattern which completed around here, and we were taking multiple shorts from here all the way down to this level around 1765. Now right now on monthly time frame it is actually being supported by this moving average, and the last week's and this current month's candle is actually very strong candle. And if the month actually closes like this, then we can have another monthly candle going upward like this, which can extend all the way to 2038, right? So test out the previous highs. So that is quite a possibility in the month of Jan. But for that to happen, this month's candle needs to close like this or even stronger than this. If there is any weakness like this, if it starts to fall below, let's say 1847, 1850 level, if it actually falls below that, closes there, then we may have a chance where the gold can fall back down into monthly profit target levels which are around here. Okay, we'll see that in a second. So that's what we have on monthly. Let's go to the weekly time frame. Now on weekly time frame it is actually not looking very bullish, right? At the moment you see the market was very bullish here, then it started to take some correction, then went back up and then started to fall back down. So if you look closely, we have an M pattern which has actually not completed here. So this is not the right place for M pattern to complete, which basically suggests that if the market starts to move upwards, then it can reach this level of near about 2026 or 2030 level, around that level which we saw on monthly approximately. But if it starts to fall down, then it is going to create an extended M pattern which is going to be around 1700 or so. Okay, so that's the first step that it can do if it starts to fall down. Just by looking at the candlestick patterns, the maximum it can go up to is near about 1906 or so, because that's where the mid of the Bollinger Band is. So it can actually go up to that level, and then there can be further down reactions. So you'll have to watch gold very closely, very carefully if you're trying to swing trade on it. So my personal advice will be if you are in doubt, then do not actually trade. You do not have to trade gold. Let it settle down, let it go into the next year, give you a clear direction, and then trade the gold. You do not have to trade every day. You do not have to trade each and every move which is being made by any market, not just gold, but in any market. You do not have to trade all the time. So right now it is not looking very good, because if you think about it, this is what a clear sign of bear trend. Okay, the market is falling, then correction, then fall, then correction, then fall. So that's the reason behind the bearishness behind this trend. So it is quite possible that it will just complete here and then start to fall. So last week what I mentioned that this was a correction, and this correction actually completed just below 38.2 Fibonacci level, and that's why I was expecting market to go bearish, but that did not happen. But there is another thing which has happened, is that this correction has now completed just below 61.8 Fibonacci level, which is still a correction. So you see that what market is trying to do, it is creating downward move, correction, downward move, correction. So you'll have to be careful if you're trying to go long on this, because there can be another move down. So that's the technical reason behind this. Okay, so if we bring an original analysis that we had few weeks ago, that is still playing out nicely. So if you remember, we went long from here, and I took my personal profit around 1846, and then I did not trade for entire week because this was way too confusing for my trading plan, and I knew that there was going to be some confusion around here because the market went up and immediately came back down. So there is a lot of up and down here. That's why I did not trade. But last week there was a very good opportunity, because this was our plan. The initial plan was that if this FCP zone is broken and if we get a confirmation, then we'll go for a long trade up to 1875, followed by the next level, which was going to be this FCP zone, and both of these long targets have been met. This was the rejection which appeared on FCP zone, and this was a very nice trade all the way there. And from there, if you were able to take short trade, then it would have made some money for you. Right now we can expect 1875 to be revisited again, okay, but right now 1878, as I said, this is also a very good level. If I go back to the weekly time frame, okay, so 1878 is around this level, okay, but there is not much difference between 1878 and 1875. So if you are going for, if you are in short for a day trade, or even for short-term swing trade, then this can act as your profit target. Hope you are already managing your trade and moving your stops, because this can, as I said, it can start to fall back down. So what is the next opportunity? So what I did on TradingView, I posted this update. If you're not following me on TradingView, then you should, because my updates will be there on TradingView most of the times. So this is the latest one. So ideally what we should be doing is following this plan, but this is more refined version. So last week and midweek I posted this, that the market was coming into this FCP zone, which is basically a refined version of the previous one, and it was supposed to fall down. That's exactly how it happened, but it hasn't actually come back down all the way to this level. Now if this level is broken, okay, let me see why it is actually showing me percentage. Should be regular. Okay, if this level is broken, then we are looking for short trades. If the FCP zone is broken and we get a confirmation, then we have long trades here. So we should be following this plan, okay, and if it actually suits you, you can follow this plan, because both of them are valid, but the left one is not that accurate as compared to this one. So all of these zones and levels are like this. They act as support and resistance levels and zones. So if the market breaks through them and it becomes support, then you can go for a long and then short. So go you will have multiple opportunities, long and short. And if the market breaks through this, then the next opportunity will be 1846 here, then 1819, then 1757, and then we will have to obviously reanalyze. Now on this trading plan, we also have extended targets, so things like this, 1875 around there, 1890, 1795. Yeah, this has become little outdated. The lower part has become little outdated, but this one is still fine. So I'll leave you with this, and if there is any change, then I will post an update on TradingView. So make sure that you follow me on TradingView and other social media channels to get the latest updates. And you're also welcome to join our free Telegram channel, where we discuss and post ideas about our trading analysis. Hi, so I'll see you in the next one. If you're interested in learning how to analyze the markets the way I do using Fibonacci Confluence, then head over to Vikinsa.com, and under training section you'll be able to see Core Strategy Training Program. On this page you'll be able to see the testimonials of previous students and also look at the brochure. The brochure has a lot more information, including the course structure and the Fibonacci Confluence Training Program curriculum. This is a very extensive program in which we cover basic core Fibonacci concepts along with the advanced concepts to analyze the markets with high probability. If you're interested in joining this program, come to Vikinsa.com, and under training section you'll be able to see and submit this form.